All right, welcome to Talk Tickers. So let's talk about Hewlett Packard Enterprise, or HPE. They just dropped what they're calling a record quarter. So why did the stock immediately get absolutely hammered? Yeah, we're going to dig into the numbers, and you won't believe the one simple word from management that sent Wall Street running for the hills. And when I say hammered, I mean it. The reaction was instant. After hours, boom, the stock craters over 9%. So what on earth happened here? This is the big puzzle, right? Record profits on one hand and a plummeting stock on the other. That disconnect, that is the whole story. So we're going to unpack exactly what management was saying versus what the numbers were really showing, and we'll pinpoint the exact thing that totally freaked investors out. Okay, so here's our game plan. We'll start with those conflicting numbers. Then we'll get into management's very rosy story. After that, we'll expose the big worry that the market just couldn't ignore. And finally, we'll wrap it all up with our thesis on what you should be watching for. All right, let's dive into the numbers first. And honestly, this is where you see a company being pulled in two totally different directions. It's a classic split decision. And here it is, the main event. You look at profitability, their non-GAAP earnings, and it's a solid beat. Great, right? But then you look at revenue, the top line, and it missed what everyone was expecting by over 2%. So think about that. They're making more profit on fewer sales. That is your first big clue that something's up. So why the split? Well, you just have to look at their different business segments. Their new networking division, thanks to the huge Juniper acquisition, is just on fire, up an insane 150%. But their older legacy businesses, not so good. Server revenue is down 5%, and hybrid cloud is down a pretty ugly 12%. So this isn't just a simple story. It's a massive pivot. The new engine is roaring, but the old ones are definitely sputtering out. And this is the really crucial part. That new networking business, it has way higher margins, and that's what drove HPE to a record 12.2% operating margin. So structurally, yeah, they're becoming a more profitable company. But the billion-dollar question for every investor out there is simple. Can this new, shiny, profitable business grow fast enough to make up for the decay in everything else? Okay, so now let's switch gears and look at how management is trying to frame all this. Because from their point of view, this is all going according to plan. I mean, listen to the CEO, Antonio Neri. He's framing this in the most positive way he possibly can, right? He calls it a transformative year, a record quarter. The story he's telling is all about smart execution and this brilliant strategic pivot to businesses that grow faster and make more money. And their whole story really comes down to three big things. Number one, integrating Juniper and becoming a networking-first company. Number two, this absolutely massive AI order book. We're talking over $13 billion. And number three, the growth of their GreenLake platform. That's their pay-as-you-go IT service. You got to admit, it's a pretty compelling vision for the long term. But here's the thing. The market, it clearly did not care about the long-term vision yesterday. Nope, it was completely fixated on one thing. Which brings us to the big worry. And here it is, folks, the guidance for the next quarter. Now, the profit guidance was fine, even strong, but the revenue forecast? Oh, it was a total disaster. They guided for somewhere between $9 and $9.4 billion when Wall Street was expecting almost $10 billion. That is a huge miss, and it screams major slowdown dead ahead. So when the analysts on the call pushed them on this, especially about that giant AI business, management used just one word to describe it: lumpy. Lumpy, what does that even mean? It means the timing of when that $13 billion in orders actually turns into real, actual revenue is, well, uncertain and uneven. And if there's one thing investors absolutely hate, it's uncertainty. To them, lumpy might as well be a four-letter word. So let's just connect all the dots here for the bearish argument. You've got shockingly weak guidance for the short term. You've got these supposedly amazing AI deals being described as lumpy and getting pushed out to the second half of next year, all while your core businesses are still shrinking. And on top of all that, you're trying to pull off this massive, risky integration of Juniper. That right there is the whole story of why the stock just fell off a cliff. So you've got this clear battle, right? A really tough present versus a potentially very bright future. So where do we stand? What's our thesis as we look ahead to the next earnings call? Well, we're giving this an equity research style reading of market perform. Look, the long-term story around AI and networking, it's totally credible, it's strong. But for now, it's being completely canceled out by these very real, very near-term revenue issues and the huge risk of getting this integration right. So from now, we think the stock is pretty much just stuck in the mud. So here's our playbook moving forward. Step one is pretty simple. Acknowledge the pain. That weak Q1 guidance is going to be like an anchor on the stock for a while, probably keeping it stuck in a range. Step two, you've got to watch the Juniper integration like a hawk. Seriously, it is now the single most important thing for HPE's future. And finally, step three, be patient. Reevaluate if the stock gets beaten down even more. If the market keeps punishing it for these short-term problems, you know what? It might just create a really attractive entry point for anyone willing to wait for that lumpy AI revenue to finally show up late next year.
And of course, remember, this is not financial advice.